$25 a month, 12 months. Here's exactly what you get and what it costs. Most people who ask about Self-Credit Builder get one of two answers. The first answer, it's a scam, you're paying to borrow your own money. The second answer, it changed my credit score. Neither of those tells you anything useful. So today we're running the actual math. Every dollar in, every dollar out, what the credit bureaus actually see, and the two situations where this product makes sense versus the two situations where it's a waste of money. Here's the situation most people are in when they find self. Your credit score is somewhere between 500 and 620. You've got one account open, maybe a secured card, maybe nothing. You've been told to build credit, but nobody explains what that actually requires from a math standpoint. So you apply for things and get rejected. You check your score and it barely moves, and you're not sure if you're doing something wrong, or if the system is designed to keep you out. That last feeling is understandable. And the answer is, you might be missing one specific credit file ingredient. Today we're going to show you exactly what that ingredient is, what Self does about it, and what it costs to the penny. We pulled Self Financial's current product terms, ran the cost math on their plan tiers, and cross-referenced the credit bureau reporting mechanics against FICO, published documentation on score factors. A disclosure before we go further. The link in the description is a direct link to Self's application. We do not currently have an active affiliate arrangement with Self. We link directly because it's the cleanest path to the application. That may change. The math in this video doesn't. One more thing before the breakdown. We are not giving you financial advice. We are showing you how this product works and running the numbers. Your individual situation, your score, your existing accounts, your debt load, determines whether this is the right move for you. If you're carrying high-interest debt right now, stay with me, because there's a specific reason you might want to skip this entirely. Here is the exact structure of a Self-Credit Builder account. You choose a monthly payment. The small plan is $25 per month. The large is $150 per month. Self puts that money into a certificate of deposit, a savings account you cannot touch during the loan term. Here's the important part. Your payments are reported to all three major credit bureaus, Equifax, Experian, and TransUnion, as an installment loan, not a savings account. An installment loan. Every on-time payment posts to your credit file as a payment on a credit line. At the end of the 12-month or 24-month term, you receive the money back, minus a one-time $9 administration fee, minus the interest self-charged on the loan. The total amount returned is less than you paid in. The difference between what you paid and what you got back is the total cost of the product. The small builder exact math. $25 per month times 12 months equals $300 paid in amount returned. Approximately $280 administration fee, $9 total cost. Approximately $29. The large builder exact math. $150 per month times 12 months equals $800 paid in amount returned. Approximately $750 total cost. Approximately $59 including fees. Here is what you are paying for, mechanically. You are paying for a 12-month installment loan to appear on your credit file. The money is collateral. The product being sold is the three-bureau credit reporting. And here's where Marcus comes in. Marcus is at a 580 score. He already has a Capital One secured card. That's a revolving account. And he saw a self-ad roll before a video. Marcus, after reading the terms for 4 minutes. Wait, I'm paying to borrow money I already have. Marcus is almost right. He's not borrowing money he already has. The structure is a loan with his own deposits as collateral, and the loan itself is what gets reported. The money is the collateral. The three-bureau installment record is the product. But Marcus moves forward. His math checks out at $29 for the small plan, and his instinct that this is technically paying for something he's creating is not entirely wrong. It's just not the framing that helps him decide whether to do it. FICO scores are built on 5 factors. Credit mix, the variety of account types on your file, accounts for 10% of your score. Per FICO published documentation, lenders like to see that you can manage both revolving accounts, credit cards, lines of credit and installment accounts, auto loans, mortgages, personal loans, credit builder accounts. If Marcus has only a secured card, his credit file shows one type of account. 0 installment loan history. Adding the Self account adds an installment loan to his mix. That change, from one credit type to 2, can have a measurable impact on his score, particularly at the 500 to 620 range, where credit profile diversity is often thin. This is not guaranteed. It is not a promise that your score goes up by a specific number, but the mechanism is accurate. Adding account type diversity to a thin file addresses a real gap in FICO scoring factors. After Marcus applies, his credit file now shows Capital One secured card revolving plus self-credit builder account installment. He has both types. That's the correct setup for someone at his stage. One revolving account, one installment account. The rest of the score work comes from keeping utilization low on the secured card and making every self-payment on time. Before the verdict, if you're on the rebuilder track, cardsmadesimple.com/rebuild has the complete 500 to 700 roadmap. Chapter 1 is free. It covers the exact sequence of accounts to open, when to open them, and how to time your applications so you're not adding unnecessary hard inquiries. Link in the description, cardsmadesimple.com/rebuild. Back to the math. Self makes sense if you match at least one of these. 1. You have a secured card and nothing else. Revolving-only credit files are common in the 500 to 620 range. If your only account is a secured card, you have zero installment payment history. Self adds that the combination of one revolving account and one installment account addresses 2 of the 5 FICO factors simultaneously: payment history, 35%, and credit mix, 10%. 2. You cannot get approved for a traditional loan or credit card right now. Self approves without a credit check for most applicants. If you're in a window where rejections are adding hard inquiries that actually hurt your score, Self is a path to building payment history without a new hard pull. 3. You want 3 bureau reporting and you want it fast. The Self account reports to Equifax, Experian, and TransUnion simultaneously from the first payment. Some lenders pull only one bureau. Having the account on all 3 means the record exists regardless of which bureau a future lender checks. 4. The cost per benefit math works at $29. Here's the comparison that puts the cost in context. A credit repair service that attempts to dispute derogatory marks typically runs $99 to $399 per month. You're not repairing anything with Self. You're building new positive history at $29 for the year on the small plan. Those are different services doing different things. But the cost frame matters when evaluating whether $29 is expensive. Skip Self if you match either of these. 1. You are carrying high-interest debt right now. If you have a credit card with an 18 to 29% APR and a balance, the interest accumulating on that balance almost certainly costs more per month than any score benefit you'd gain from Self. The math is, pay the high-interest debt first. The credit score will improve as utilization falls anyway, and you keep more money. 2. Your score is already above 680. At 680 plus, your credit file has reasonable depth. The marginal gain from adding a credit builder account to a file that already has established history, managed utilization, and multiple accounts is smaller. At that point, the opportunity cost, $25 to $150 per month tied up in a CD for 12 months, may be better deployed elsewhere. The honest framing. Self is a tool for people who have thin credit files and need to build installment payment history. It is not a shortcut. It is not a repair service, and it does not work faster than 12 months. If that's your situation, it's worth $29. If it isn't, it probably isn't. Clear verdict. 2 situations. If you are at 500 to 620 with only revolving accounts, or no accounts at all, Self's small plan at $25 per month is worth the $29 annual cost to add an installment credit line to your file. Apply at app, Self, Inc. Link in the description. If you are carrying high-interest debt or already have established credit, skip Self for now. Pay down the debt first. Revisit when the balance is cleared. Marcus ends this episode with both a Capital One secured card and a self-credit builder account on his file. He will tell his coworker it's basically a savings account. He is not wrong enough to stop him from making the right move. That covers the credit builder loan, what it costs, what it does, and who it's actually for. But there's one thing we haven't addressed. Marcus now has 2 accounts open, a secured card and a credit builder loan. His score is moving. The next question is when and how to start moving from secured to unsecured. That transition has a specific timing window, and if you miss it, you leave points on the table. That's next. If the math in this video saved you time or confusion, the like button is right there. Subscribe and you'll get the secured to unsecured transition episode the day it drops. The complete 500 to 700 roadmap is at cardsmadesimple.com/rebuild. Chapter 1 is free. It's the exact sequence of accounts Marcus is following, with timing guidelines and a simple tracker you can actually use. This content is for informational purposes only and is not financial advice. Credit card terms, rates,